Okay, in this video, we are going to go through dividend rates. Dividend rates with life insurance companies and what does the future hold? Where are things going? You know, I've mentioned in a couple of videos, I've sprinkled it in there, but here, I'll just let you know directly, is I've had conversations with some of the top insurance carriers, and this was prior to COVID hitting and the ultra low interest rate environment occurring that we're in right now. Is before that had happened, insurance companies felt that the low interest rate environment we're in right now is going to remain low for at least another 10 years. So they've been revamping their products. When the new mortality table update came about in January 2019 or January 2020, when everyone was forced to abide by the new tables, products were updated and they did factor in what was happening with the interest rate environment at that point in time. And again, their comment was, we feel that the next 10 years, interest rates are not going to be going up. We think we're going to remain in this low interest rate environment, so we've got to make moves to accommodate. So with that said, if the interest rate environment does not increase, does that mean that dividends are likely to increase? No. Not at all. I would expect things to come down a little bit or remain the same. I'll get into that in a little bit here. What I want to go through first is a little bit of history. This will set the stage for everything properly. So in 1980 is when the guaranteed interest rate of 4%, guaranteed cash value interest rate of 4% was introduced with most whole life insurance companies. Prior to that, you'd see it right around 3.5%. And if you go further back, it was at 2.5%. Now, we've got the total dividend rates here. Now, it ranged between different carriers, but in 1980, you see it was between 7 and a little over 8%. 1990, so you're in the tail end of the 80s there, ultra high interest rates, dividend rates between 10.5 and 11%. It's attractive compared to today, isn't it? 2000, 8 to 8.5%. 2010, that's after 08, 6.5 to 7.25%. And then 2020, you'll see them range, especially with the top companies, between 5 and about 6.2%. Now, a quick note to make here is when I see a dividend rate, is that what I'm earning on a life insurance policy, on your cash value? The answer is no. Remember that the dividend rate, and the same thing applies to the guaranteed rate, is a gross rate that is credited after the company's insurance expenses and mortality charges. So what I want to look at is the net internal rate of return. What's my cash value actually growing by is what that means. So we've got videos and studies on that. The simple answer is when a policy is designed properly, whatever my gross dividend rate is, I can expect the net internal rate of return to fall somewhere between 1 and 2% below that gross dividend or gross guaranteed rate. We're going to look at a quick example in this actually at the end of this video. So some history on dividends. Next 10 years, right? Because the insurance companies, they don't tell me, here's what our dividends are going to be the next 10 years. If they knew, then they don't know. It depends on the company's investment performance and such, and some other factors. But our prediction, I would peg it somewhere in that neighborhood between 4.5 and 6%. The net internal rate of return, I'd expect to fall somewhere between 3.5 and 5.5%, depending on how long the policy is in force. That is critical. And also looking at the annual internal rate of return, meaning what am I earning each year? And then also the average internal rate of return. What have I earned over the life of the policy? Let's look at a quick example here. All right, so here's an example. 40-year-old male, just funding a policy. We max funded it for 7 years. The funding doesn't matter a whole lot here. We optimized it for cash value. But first, looking at the guaranteed rate of 4%, annual internal rate of return, what am I earning each year? So based off the guarantees, we see it top out at about 3.35%. Now, if you've seen any of our content, cash value life insurance, core benefits of it are as follows: safe, liquid, tax-free if you do everything right. If we don't mech it out, if we don't lapse it with a gain. So that is a 3.35% annually that I'm earning there, tax-free. What do I have to earn in a taxable account to get the same thing? Do I get 0.35% in my bank account? Another question there. But that is the annual. I can also look at the average over the life of the policy. What am I earning? Tops out a little over 2.85%. This is the guarantees. Looking at very close to a worst case scenario here. So net internal rate of return. Now, based off of a dividend rate of 5.65%, excuse me, annual average, there we go. So I mentioned that 3.5 to 5.5% range. We see the annual IRR exceed 4.1. The average come very close to 3.75. Tops out at about 3.74, and that's as you're getting to the 30-year mark. So that's a long period of time, assuming that dividend rate remains consistent forever on this example, which will not happen. Obviously, we've got 10 years and then another 20 to hit that year 30 mark. So things will come down a bit, then come up. That's where always keeping track of the policy performance, keeping our finger on the pulse of the company, the insurance industry, all that good stuff is critical. And then we've got a dividend assumption that comes out to about 5.88%. Same thing there. Internal rate of return is what I am interested in. So that's just some demonstrations there. The main question here is, right, what do we think, if I were to just guess, this is 100% a guess, what we think dividends will fall at over the next 10 years or so, seeing the trend, what's going on, where companies are positioning their money, somewhere between that 4.5 to 6% dividend rate. So with a net IRR of 3.5 to 5.5%, that's great. The question is though, right? So when it comes to a cash value life insurance policy, great place to store money, but we've got the other benefits of using it, right? So we always talk about how do I maximize the cash value first? That gives me the money so I actually have it there. And then step two is how do I use it? Whether I'm using it to invest in my business or real estate, which is where the strongest returns are. Using it to pay off debt, that's a great use of money as well. So maximize it, and then for storing cash, if my other alternative is a bank account, is this a better place to store it? I have the life insurance benefit too. If I die, money's paid income tax-free to my beneficiaries. So how will the insurance companies continue to sustain this, right? So where are they investing first and foremost? So we've got a couple key areas here. Historically, insurance companies have been very, very bond heavy. If you go back to the 80s when bonds were double digits, right, you'd see an insurance company's portfolio very rich with bonds. They just buy the things and hold on to them. It made life very easy to pay a dividend, let alone credit the guarantee. Very simple to do. Can't really do that today in the current interest rate environment. So investments they have, bonds, mortgages, high-end commercial real estate, typically always cash flowing, whether that's multifamily units, whether that is leases in metro city areas, right, where the foot traffic is constant, leases are continuously paid no matter what. That is something they're looking at. And then also businesses. What's interesting, if you look at a lot of companies, especially the larger carriers, they actually have venture capitalist divisions. You know, a sector that is designed to invest in other companies, buy other companies, they sell other businesses and such, which help with their profits and revenue. It's really interesting when you see that. A great example would be MassMutual, right? They, for the longest time, had owned Oppenheimer Investments. They had sold them off in 2016. I believe it was June or July of 2016. They had bought a division of MetLife. That what they specifically bought was their retail sales division, which had helped increase their revenue and products sold. And all companies make moves similar to that. Those are just some recognizable names what MassMutual had acquired there. Point being, where are they investing their money? Now, these are a couple areas, and why I mention this, the insurance companies actually have to disclose where they're positioning their money through what is called a vital signs report. Now this one ran through the end of 2018. These are updated very slow. We can get 2019 now, but this ran through the end of 2018. We've got 4 companies here, but I know who they are, but I'm not going to go through the names and such here. total admitted assets, but look at this, invested assets. Now this bond allocation has come down since this report, but if you go back 10 or 20 years, you'd see a different story here. But you see bonds, stocks, percentage in stocks are very low. Other invested assets. That, personally, I would expect to come up a bit as they continue to become creative and look at other areas where they can position their money and such. And these reports, we can obtain them through a number of sources, and we can run several custom reports as well. But that is where some of their investments are. And the other thing, improvements, right? So with insurance carriers where dividends were very high back in the 80s, for instance, was their underwriting, was their processes as an insurance company as efficient back then than what they are today? Not even close. So much more efficient, so much more productive from, call it, an underwriting process. So for example, underwriting, right? If you're running a business, speed and accuracy is important. Speed is important from a business standpoint. People want to get their policies in force, right? The most frustrating thing for a policyholder, an agent, the insurance company is when underwriting takes 6 to 10 weeks to make an approval. And the underwriters, they're not deliberately giving people a hard time. They're trying to protect the insurance company. They want to make sure that that person is going to live for a long time. They don't want to make a decision that comes back inaccurate, and now all of a sudden they're on the hook to pay out a claim that they inaccurately projected. I thought I was going to pay it out when he's 90. He died at 65. That's money we got to pay out much earlier. That's the kind of stuff the underwriters have to protect from. So accuracy is critical here. Yet speed, from a business owner standpoint, is critical. You got to move fast. So that has improved. You'll see a lot of companies, they've really increased their level of production speed. They've put processes in place. I've seen some companies investing heavily in this, the AI side, artificial intelligence. And it's interesting, the companies that I have seen invest in that or make a decision to invest in that many years ago are now all of a sudden moving quick. And when COVID hit, I did notice the companies that made decisions to invest in that heavily, they were much, much better equipped for that from a business standpoint, customer service standpoint. They did a good job without naming any companies there. Point being, that certainly helps, especially from an underwriting but actuarial standpoint too. Imagine if you could collect all of this data and instead of doing everything manually and with the technology we have that we're used to, have a system figure it out for us based off statistics and such. It's pretty cool stuff. But other things we have, product enhancements. As times change, products are going to be enhanced, adjusted. Sometimes they're much better for the consumer. Sometimes the old products are better. So it's good to always be aware of that. We hear a lot of times when it comes to cash value life insurance products, hey, this is the way that it's been done forever. We want to go with the way that was done in 1982. It's like, no, bro, if things change, right, see what's available, take advantage of the adjustments that will help benefit the situation. And if there's not one there, keep doing it the way that's effective. But always look at how you can enhance your product as opposed to just getting stuck in old ways. Companies that have enhanced their products, I see, have continued to grow and continue to be very competitive on their dividend rates. And when you look at their guarantees, they're very strong there. Business and personal development. So companies investing in their business, in their sales force in order to push more product ultimately. Marketing. This is important. That's going to brand them, help them continue to drive sales. And then, of course, sales. Getting into different marketplaces. For example, if you look at companies out there, MassMutual and New York Life have phenomenal BOLI products, bank-owned life insurance products, top tier. Guardian, another one of the 4 major mutuals, made a big push into the individual marketplace in 2008, actually, when a different CEO took over the company, and they did a phenomenal job when you look at what they've done as a company during her time span as CEO. It's impressive right? When you look at what they do, their product in the individual marketplace, their disability insurance product has always been solid, but they made a great push, business, marketing, AI, personal development, all of this good stuff. And a lot of companies do it, right? These are just examples that come to mind. And as I study and observe the insurance industry from being in the front lines, but seeing what others are doing as well, it's interesting. So there's a lot of information there about dividend rates and what the future holds. Here's where I'd peg it for simplicity. Somewhere in that neighborhood, net internal rate of return, peg it between 3.5% and 5.5%. Is it still a phenomenal area to position money? Absolutely. And proof of that kind of goes back to the core fundamentals. What are the wealthy doing? Big banks, corporations, wealthy individuals continue to position boatloads of money here. The reason why is, one, for a safe area to position money, that's solid. Even when I look at the guarantees, if the policy is structured properly. But it's also thinking long term, going beyond just the next 10 years, where dividends will likely come down a bit, but what happens beyond then? Maybe they continue to flatline. At some point in time, you'd imagine they would come up. Whether it's 20 years, 30 years down the road, whenever it is, eventually you'd expect them to rebound and such. But do hope that this provided some value. If you have any questions, feel free to reach out anytime. We'd love to talk to you, and I hope this helps. Thank you. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.